Good morning, everyone. We'll just wait for a few more seconds for to be settled in. Definitely, it's a great informative presentation that we have set for you for today. Also, some general housekeeping items. This is a recorded webinar, so in case if you have to step out, answer a phone call, don't worry. You'll be able to receive the presentation along with the video recording as well. If you have some questions, strongly encourage you to put them in the Q&A so that throughout today's webinar, we'll be more than happy to moderate them on your behalf as well. This is a good opportunity to networking. Introduce yourself. What stage in your business are you in? So like that, our presenter will be able to have an idea and also provide some additional tools and tips for your business success as well. So I want to thank you all for attending today's presentation. And allow me to briefly talk about the Miami-Dade Business Navigator program. Also, I'll introduce you to Jerry Grimes-Lewis as the Executive Director of the EDC of South Miami-Dade that will briefly talk about the initiatives and programs that the EDC has to offer for your small businesses as well. So a brief description of what is the Miami-Dade Business Navigator program is funded through a cooperative agreement through the U.S. Small Business Administration. It is established in part of the American Rescue Plan Act of 2021 that uses a community navigator approach to help you, the small business owners. It is comprised as a lead hub. In this case, it is the Florida SBDC at FIU, working with a network of spoke organizations that work with small businesses in the community. The focus is placed on businesses owned by veterans, women, as well as socially and economically disadvantaged individuals. Along with the Florida SBDC at FIU, we also have 6 great organizations working together as one. If you're looking for access to capital, credit management, government contracting, networking opportunities, starting a business, we have Sunbiz, branches, Miami-Dade Chamber of Commerce, Prospera, Start by FIU Procurement, along with the Florida SBDC at FIU. We have all these 7 great organizations to assist you at no cost. And allow me to introduce you to Jerry Grimes-Lewis from the EDC of South Miami-Dade to briefly talk about the initiatives and programs they have to offer. So, Jerry?
Good morning, everyone. Thank you for joining us. I'm having a little bit of technical difficulty, so if I lose you, I apologize in advance. So the Economic Development Council of South Miami-Dade, our reach, so to speak, is Kendall Drive and South. We support and involve ourselves in anything that can lift the South Dade community up, be it economically, be it traffic. There's all kinds of issues that we get involved with to make living and working in South Dade better. A quick example, there was going to be, I don't know if everybody knew, but the Florida Turnpike Authority was going to do a flyover and completely bypass Palm Drive or from Lucy Street and completely bypass that corridor in Florida City that has all the restaurants and gas stations. And we lobbied pretty heavily to ensure that that didn't happen, and indeed it did not. Some of our current initiatives, other than working with the navigator, which our role in that program is, I don't know if you've ever Googled anything for your business, but you get like a million different options on Google. And we like to think of ourselves as kind of the filter where we spend some time with you, we talk to you, and we figure out, what do you really need? What do you really want? So we can filter through all of that noise and put you with the right person, whether it's financing or business plans or anything that has to do with either the beginning of your business, during your business. We've even worked with a gentleman who was selling a business. So that's what we do. And we are happy to help. You'll get all the contact information along with this presentation. And again, I thank you for spending your valuable time with us this morning.
Thank you, Jerry. The focus is to create that local community navigator approach here in Miami-Dade County. But if your business is located in Palm Beach, Broward, and Monroe County, we'll be more than happy to assist you. If your business is outside of that jurisdiction, in the chat, you'll have my email address, and I'll be able to connect you with your local small business resource partner. The overall focus of this project is to focus on the three key pillars, which is the consulting, the mentoring, and trainings as such you're in today. Definitely encourage you to like and subscribe our YouTube channel, as we have a plethora of additional webinars that we have done to enhance your business needs, but also for additional tools for your toolbox, along with follow us on our social media channels, as we have events, resources from all different faucets for small businesses. At the end of the day, it's not just power. So definitely encourage you to follow us on our social media channels, like, subscribe our YouTube channel, so that we could definitely continue to working with you as well. So without further ado, allow me to introduce you to Davide. He is our presenter today, and definitely encourage you to, the easy questions send to me, the hard questions send to him, and like that we'll be able to have today's presentation. But definitely, like I said, any questions throughout today's webinar, strongly encourage you to put them in the Q&A. So like that, my colleagues will be moderating the questions, and when sent for Q&A, we'll be able to ask those questions to Davide. So thank you all, and Davide, the floor is yours.
Thank you, Jesus. Thanks, everybody. My name is Davide Proietti. I'm an attorney at Marco and McGolnick. That's the name of my law firm, and I'm going to share screen. So I'll see the presentation. Okay, as I was saying, I'm a shareholder at Marco McGolnick, where I practice corporate transactional law. So what does that mean? I help small businesses stay out of trouble, primarily when it comes to agreements, transaction. We have a few things to cover today. We'll talk generally about finance and law topics that I think are very important for startups and ongoing small businesses. So first we'll talk about basic budgeting and financial statements, the importance of keeping records straight, dotting the I's and crossing the T's. We'll talk about the corporate form. So what is a company? What does it mean to start a company, to form a company, and some choice of entity issues that often come up. We'll look at some resources that are available to you in terms of, the basic needs of your business, right? Some of the initial filings that you're going to have to do, where do you do them? How do you do them? Banking, opening a bank account, all of that stuff that's sort of, the first steps of your business. And then I guess maybe a little bit more philosophically, we'll talk about conflict among owners. In other words, the issues that I see coming up in practice and the grounds for disagreement and disputes, and what happens if, right? So planning for unexpected life events, the unknown, disagreement, things that, oftentimes in the enthusiasm of starting a business and focusing just on the business, business owners may forget, but nonetheless are very important and should be taken into account. And then we'll have some time for questions at the end, or feel free at any time during the presentation to go during the Q&A section. So financial statements, generally speaking, there's four financial statements: income statement, balance sheet, statement of cash flows, and statement of changes in shareholders' equity or owner's equity. Now, the first two, the income statement and the balance sheet, are, I think, the most important, the most applicable to small businesses. That's not to take anything away from the other two statements, which are also important, but in the small business context, they are not as relevant, right? Well, they're fundamental for large publicly traded companies like Apple or Microsoft or what have you. For your typical average small business, they're not so critical. So the income statement, what is it? What does it do? What does it tell us? The income statement, also known as P&L, profit and loss statement, or statement of the results of operations, it shows you that it shows you how much money did you make for that specific fiscal period, which is generally a year or a quarter. It's very useful because it provides the operating health of the business, and it's very easy to understand in a split second if your business is doing good or not. So it's an immediate measure of the health of the business. You literally look at the bottom line. If it's a black number, it's okay. If it's a red number, you have some trouble, right? It means you're losing money. Of course, there's more to it, but my point is that of all the financial statements, this is the one that immediately tells you yay or nay. The balance sheet is also fundamental, and the way that I think about it is that when you're building your business, when you're running your business, you're building this house, this structure. The balance sheet shows you the structure of the house and the underlying foundation of it, and it tells you whether that construction that you're putting together is solid or not, and how is it balanced on top of its foundation. So it's a foundation of the business because it shows you structurally the sources of funding for your business assets. I put in there, it's important to understand the difference between income and assets. Sometimes, business owners get confused. They say, well, my business is making money. Money is an asset. So yes, but it's important to understand the distinction between the results of operations and the money that you're making or losing, and your revenues and your expenses, versus the acquisition and disposition of assets. So an asset is a permanent thing. It's something that stays with you. I mean, it could break, you could sell it, you could give it away. But the point is that it's not it's not a flow. It's not something that goes in or out. It's something that stays with your business. And so this is the concept of capitalization, right? Capitalization. So you invest resources in your business to build assets, and the balance sheet tells you how were those assets created? What's the foundation underlying the building of those assets? So these two are the most important statements. A quick word about the remaining two, just to explain what they are. So a cash flow statement shows the actual cash that goes in and out of a business. Why do I say that it's less important for a small business? That's because a vast majority of small businesses report income and losses on a cash basis, meaning they sell a widget, they get paid $10, they report $10 as revenues. For different types of businesses or businesses that are larger, you may have a more complex reporting system, which is called accrual accounting. Accrual accounting is based on the accrual of a right or of a liability. And so the example of it, in plain English is the following. Let's say I sell a widget, but I don't get paid in cash right away. I get paid, 30 days out or 60 days out. I'm going to report on an accrual basis a revenue because I have a right to collect that money. I sold the widget, right? I made the sale. I have a signed contract to sell the widget. There's a purchase order. There's an invoice that was sent out, but that invoice is not due until, let's say, 30 days. So I don't actually see that cash for another month, and it would be improper for me to report that I got the cash today because I didn't. So there's going to, when you apply accrual accounting in this scenario, you're going to show on the income statement the revenue because you have a right to it, but there's going to be a discrepancy with the cash flow statement, which instead is going to show no corresponding inflow of cash. And that's the entire complete and proper picture, because what those two statements together are telling you is, yes, you have a right to that money, but no, you haven't collected it yet, right? And so again, this is important for large corporations. They use this particular method of accounting, but in small businesses, it's not as widely applicable. It's used often for valuations. in the small business concept. So, business appraisers generally use statements of cash flow because cash flow is used as a metric of calculating the value of a business. And another important note about the cash flow statement is that it includes non-operating flows of money. So the cash flow statement tells you about all the cash that goes in and out, but just because the cash flow statement has a positive number, it doesn't mean that your business is doing well. In fact, let's say catastrophe scenario, your business is going bankrupt and you're selling everything that you have to get rid of it and try to pay your debts. When you're disposing of assets, your cash flow statement is going to show a positive number. So that's not necessarily a good thing because you're getting rid of stuff because you're failing, but the cash flow is going to show the positive cash flow of the liquidation of the asset. So again, just a few concepts to keep in mind, the difference between the cash flow and the income statements and the reasons why one is more applicable than the other to small businesses. Finally, the statement of changes in equity, it's really only applicable to public companies. What this statement does is that it specifies when there's many different classes of share ownership and stock options and warrants and equity compensation for key executives, this sort of complex corporate structures. This statement shows you how the net income of the company affects each one of these classes differently, and what happens if some options are exercises, and what happens if there's a dilution event, and so on and so forth. In your average small business, you don't have all of this complexity. You have one, maybe a restricted group of ownership. Everybody is on the same class of ownership. It's just a different percentage. So this is really almost never applicable to a small business. So income statement, balance sheet, those are the two most important financial statements. And since they're so important, let's take a quick look at them. So the income statement, like I said, quick temperature check. What do? Look at the bottom line. Are the numbers black? Great. I take a breather. I'm doing okay. I'm not losing money, right? So that's the immediate check. Takes a split second. Of course, there's more to an income statement. Now, I'm not a CPA. I don't pretend to be. This is not an accounting class, so we are not going to get into all of the financial ratios and interpreting accounting statements and all of that stuff. But what I think is an important point to make about an income statement is that it provides a lot of useful information, and it's especially useful when you look at it based on trends, right? When you have a history of it. So in this example, we have 3 years for this, XYZ corporation. You have 3 years worth of income statement. And what's interesting, just as a quick example, is the fact that if you look at the sales, you have in 2015, historically, 233,000. Then it dips a little bit in 2016, and then it picks it back up in 2017, right? Now, the cost of sales, which is, I don't know, if you're selling widget, this is the cost of the widgets, which should be proportional to the sales. If you look at the evolution of that over time, you see that it starts at 140. It also goes down in 2016, but then somewhat surprisingly, in 2017, it gets even higher than where we started in 2015, even though the sales are lower. So why am I telling you all of this? Because if you just look at the numbers in and of themselves, they may not tell you a whole story. But if you dig a little bit deeper, or if you hire somebody to dig a little bit deeper, the numbers are telling you, hey, business owner, you're becoming inefficient. There is something happening in your business that's causing you to increase your cost of operation in a manner that is faster than the growth of your sales. So yes, for now you're okay because you're still in the black and you're not in the red, but this is something that could potentially be an issue. You got to look into it. What happened? Find out, do the research. Did your, I don't know, suppliers become more expensive? If you're manufacturing the widgets, are there issues with the production line? Or did you have to redo a bunch of widgets because you had some issues? Are there, other inefficiencies in the structure? In other words, think of it as sort of an alarm bell that goes ding, ding, ding. Look at me, pay attention to me. There's something you may need to do here. The next statement is the balance sheet, right? The other big one. The basic formula of the balance sheet is the one right here at the bottom: assets equals liabilities plus equity. Now, the balance sheet, you can picture it graphically as two sides, and not surprisingly, they have to balance. That's why it's called a balance sheet, right? So this is where the formula comes in. The total value of your assets on the left has to equal the sum of your liabilities, the debt, and plus the shareholders or owners' equity, which is the capital contributions. Now, as I was saying before, this is the structure and foundation of your business. So the assets are the things that you own, right? And then on the left side of the balance sheet, and then on the right side of the balance sheet, you have the foundation for that building, right? How did you get them? How are those financed? If it's in the liabilities section, it means you borrowed money in some way or another, whether it was a form of bank loan or were advances of credit or revolving lines or, you know, deferred vendor payments. There's some sort of a legal obligation for you to pay in the future. That's a liability, right? So assets can be financed with liabilities. The other form of financing assets is owner's equity. What does that mean? Money that comes out of your pocket as the business owner, right? Capital contributions, the money that you put into your own business, plus the net income, if any, from the prior year, right? So if you made money last year, the business generated its own contribution to itself. So that also goes into the shareholders' equity. And that's this portion right here, which is the retained earnings and accumulated income. Another quick word on the balance sheet is the presentation of the items is not random. It follows a specific order. The assets are presented in order of liquidity. This means that cash is first, and then everything else is listed based on its ability to be converted into cash, right? So how fast can you turn the asset into cold, hard cash? Quick example is accounts receivable, right? So this is when you sell goods and you have an invoice outstanding, say 30 days. It's an asset because you have a right to collect that money. It's yours. You sold the widgets. You need to get paid, but you don't have the money just yet. You need to sit around for 30 days and hope that your customer doesn't go bankrupt in the meantime, right? So is it as good as cash? It's pretty good, but it's not up high in terms of liquidity. It's a little bit lower because it's not cash just yet. You need to wait a little bit. Liabilities on the other side are presented in order of maturity. What does that mean? The more urgent ones are listed first, and then the longer term ones are listed last. So for example, on the balance sheet, you buy real estate with a mortgage, you would put the real estate asset, since it's not very liquid, you would put it at the bottom of the asset list. And then the long-term mortgage note, you would put it as a long-term liability. And so it's interesting how these two orders of priority in and of themselves tell you a story, and they make sense logically, because in the example that I just gave you, the long-term asset is very illiquid and it's financed by a long-term liability that it's not mature just yet. So the order of presentation of the information also tells you a story about the structure of your business. Creating a budget. So it's important, needless to say, when you're thinking about starting a business, that you create a budget. What you should do is essentially a combination of these two primary statements, right? The income statement and the balance sheet. On one hand, the, let's say, income statement like budgeting is estimating sales, right? Considering different scenarios, because business owners tend to be overly optimistic. So picture your best case scenario, a middle ground, and a worst case scenario at least, so that you have different possible outcomes in terms of sale. and then brainstorm cost items while allowing for a little bit of a cushion, because unexpected things always happen. So in a way, I'm pushing you to expect the unexpected. Create a line item in your budget as an expense, which is stuff that could come up, right? So this is the income statement, revenue and expenses, and then you do the difference and you get the net income. On the balance sheet like side is identifying assets required for the operation. For example, I need a widget making machine, I don't know, right? And understand how you finance it, right? So picture the building, identify the foundation. How do you build the building? Where do you get that money from? Do I borrow money to buy the widget making machine? Do I put in my own money to buy the widget making machine? So keep, in the back of your mind as you're going through your budgeting exercise, keep in mind how that's going to translate into the underlying financial statements of income statement and balance sheet. Here's some useful formulas. As Jesus was announcing at the beginning, everybody's going to get a copy of the presentation, but here's some important financial analysis formulas that will help you get more insight about your business, because as we've seen so far, numbers in and of themselves tell you only a part of the story. When you start looking more carefully and you break down those numbers and you slice and dice them and you apply these formulas, you're going to realize, for example, doing a break-even analysis, you're going to realize what's the dollar value of sales that you need to achieve in a year to cover all your costs to get to the zero profit point. So that's important when you're budgeting, because that tells you, for how long do I have to stay in the red before I can push my head out of the water and start breathing and start making money, right? And so that's important because it tells you, I don't know, you're going to operate at a loss for 6 months and then you should make money, and you say, okay, so I should budget to have 6 months of expenses covered so that I know that I'm going to be safe for that period of time. How do you finance your loan? Your business, you can get a loan, you can get grants, you can get, a number of different resources. Here's a sort of a small list of many different resources that are out there. Of course, use the Navigator, use SBDC, use the Florida DEO, Department of Economic Opportunity. There's a lot of resources out there. That's really my point. This is just a small list, but do your due diligence, learn about these things, ask, seek mentoring, right? Get informed. It's not just about looking into your own pockets or asking friends and family. You have avenues to find funding so that you can start your business. And all of these generally require that you do some homework. In other words, people are not just going to give you money for free, right? You have to show that you deserve it. And that process, that homework that these organizations make you do in and of itself is a valuable process, because you're learning as you go through it. You're understanding the weaknesses of your business, right? Don't just start the business for the sake of saying that you started a business. Start a business to be successful. Start a business to make money. Stress test your idea. Make sure that it works. Trying to look into these programs and understanding their requirements and understand how to do that homework will, in a way, force you to go through that process of evaluating your business idea and, like I said, stress testing it. Okay, let's say that you run the numbers, you do your homework, you do your budgeting, you get your funding, and now a company is born, right? As you're thinking about how to incorporate, or I shouldn't say incorporate, maybe it's an LLC, so form a business, you need to consider what type of business you want to start. So this is what I've noticed, at least, if you go online and you try to Google this question, you get a million different answers, and you get a lot of people saying you could form a corp or an LLC or an S-Corp or a sole proprietorship, or you could start a DBA. And I cringe a little when I see all those things, because under the law, those are very different things. They're treated very differently, and you could really get yourself in trouble unknowingly if you don't understand what it is that you're doing. So to make a very long story short, I will just say this. There's many different types of entities that you can form, that you can create. Corporations, LLCs, general partnerships, limited partnerships, limited liability partnerships, blah, 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 blah. We don't care about 95% of them. There's really only two that we should focus on, which are corporations and LLCs. These are entities, right? These have a separate legal existence. Under the law, a corporation or an LLC is recognized as a person separate from its owners. It's a legal person. It's a fiction. It's not a real person, but it's recognized as a person. So a corporation or an LLC can own title to real estate, to property, can file a lawsuit, defend the lawsuit, borrow money, open a bank account, do all the things that a normal person can do. Why is that important? Because the fact that it's a separate legal entity allows you the beautiful thing that is limitation of liability, right? What does that mean? That means that if your company does something wrong in the conduct of its business, your company is going to get sued and not you individually, right? So you are protected from the liabilities involved with running your business. Now, if you own an LLC and you run someone over with your car, that's still your problem, right? The company doesn't save you from that. But if you run your business and have an LLC or a corporation and you sign a contract with a supplier and then you can't pay them, now your corporation can go into bankruptcy or your LLC can go into bankruptcy, but you don't have to individually, right? There's a lot of confusion about state laws and federal laws, especially when it comes to the tax environment with respect to choice of entity, because I often see, again, online, a lot of sources that say, oh, it's great to form an S-Corp. It's an excellent vehicle. It's a great entity. Folks, S-Corps don't exist. They're not an entity. What you do, you can't create an S-Corp. What you do is that you form a corporation or an LLC, and then you preferably go to a CPA. But then what you do is that and that's under state law. Under federal law, you file a form with the IRS where you say, dear IRS, will you pretty please treat my company, corporation or LLC, and tax it under subchapter S of the Internal Revenue Code as a qualifying small business corporation, which is subject to specific tax rules. In short, because this whole thing is a mouthful, it's an S-Corp. But it's not born as an S-Corp. The S-Corp is not an entity. The S-Corp is a special tax treatment that you can elect for your company, okay? If certain requirements are met. It's not an automatic thing. There are some restrictions on who can and cannot apply. My point to you is simply this. Careful when you Google information in that sense. If you read an article that says that forming a DBA is sufficient to start a business, stop reading that article. A DBA is not a separate legal entity. A DBA does not protect you from liability. If you're doing business under a fictitious name, but you don't have an LLC, you're responsible personally for everything that you're doing. A sole proprietorship is not a business. It's not an entity. It's just me going out in the street and being a businessman. That's no good. You have unlimited personal liability. If I do something wrong in that context as a sole proprietor, people can take everything I own, right? I'm going to get sued personally. Everything I own with the exception of homestead property. That's another class in law school. But anyways, the point is that be wary of loosey-goosey legal advice on the internet. Google University is great for a lot of things, but when it comes to these minutia and specific legal details, it's important to understand sole proprietorships, DBA, do not give you protection, do not give you limited liability. Corporations and LLCs do, so you should form those. Now, which is better, corporation or LLC? Well, the real answer, the accurate answer, the long answer is that it depends on a number of different parameters that should be carefully evaluated with a professional. The short answer, to make it simple for everybody, is that I'm going to say in 95% of all cases, the LLC is the better option. And here's why. They both provide the same basic important things that every small business owner needs, but an LLC allows you more flexibility. Why is that important? Because as a small business, you need to be nimble. Maybe you need more money tomorrow and you need to bring in a new partner. Maybe you're not so good at maintaining your internal corporate formalities. Maybe you want to change your way in which you're taxed in a year or two because it makes more sense based on your personal finances. The LLC allows you more flexibility as an entity. Corporations are good. They give you limited liability. They allow you to do certain specific things, but they're more structured. They're more crystallized. And so is that always a bad thing? No. But again, in 95% of the cases, small businesses benefit from the greater flexibility afforded by the limited liability company structure over the corporation. So in conclusion, which is best? It depends. Vast majority of the cases is an LLC, and speak to a CPA because a lot, so the driving force in choice of entity problems, especially early on, is primarily tax driven. In other words, you don't want to end up paying more than what you really owe. So it's important to structure this properly with the help of a tax professional so that you can make an intelligent decision and not find yourself, come April 14, that you get a huge tax bill and you're like, oh my God, I wish that I had done this last year, right? Okay, so get your ducks and docks in a row. Dot the I's and cross the T's. I'm an attorney. I love doing this stuff. But business owners hate it because it's boring and it's time consuming. But let me tell you something. You got to do it because it's important. And if you don't, you run into a lot of trouble. So one thing we're going to look at is Sunbiz, which is the Florida Department of State Division of Corporations website. I want you to see it. I want you to become a little bit familiar with it because it's a website. It's easy to access. It's easy to use, but it's very important. So I want everyone to see it. We'll talk briefly about taxes. Again, I'm not a CPA, but important things you have to do: get an EIN and understand state and federal taxation, elections, and timings. Bank account or accounts. Remember to KISS. Keep it separate. Seriously, it's very important. Don't commingle business and personal assets. We'll look at that. Careful with loans and personal guarantees. They could create personal exposure in spite of the fact that you've created an entity for limited liability. So be wary of those. Brief mention of permits and licenses, some of the most common ones. And I also have this website that I love. It's a Florida government website, openmyfloridabusiness.gov. It's a great tool. You go online, you put in what business you want to open, and it tells you, it gives you a checklist. Here's all the licenses you need to get. It's not the equivalent of getting a lawyer on board, but it's an amazing starting point, and it's free. It's very easy to use. And then corporate formalities, which is the nitty-gritty legal stuff that I love and that I work on a daily basis. So Sunbiz. This is what the main Sunbiz page looks like. There's two functions that you're going to use most often, which are searching records and then the start a business menu that has a number of different options. We'll take a quick look at each of them and what they do. So if you go on to start a business and you prepare your initial filing, your articles of organization or articles of incorporation, if it's a corp instead of an LLC, are going to look something like this. It's a very, very, very simple form, right? The basic filing to form a company, it's very simple. You only need to say the name of the company, principal address, mailing address, the address of a registered agent. This is a person that is designated to accept service of process on behalf of the company. So if The company gets sued, the process server can't say you've been served to an entity. There has to be an actual physical person who gets the papers and says, okay, I understand this company has been sued. That's your registered agent. So you have to list that. The managers, so who has authority to sign on behalf of the company. And then this is not even required, but an effective date, which is the birthday of your company. If you don't put it, it defaults to the filing date, right? Which is the date of the stamp. Easy. 5 things. There's not a whole lot that's necessary to form an entity, right? One thing that I want to mention about this filing is that it's in the manager portion, right? The management. I cannot tell you how many times people say, oh, I want to see who owns this company. Let me go on Sunbiz. Calls with bankers saying, oh, no, you're not an owner because you're not on Sunbiz. Folks, listen to me. Sunbiz does not show you ownership. It shows you the people who are authorized to bind legally the company. It could be a third-party manager that's just an employee, but has authority to sign checks. It's not ownership. There could be 10 other owners in this company other than Vincent who just simply don't have authority to bind the company, right? In this case, right, it's important to look at the title. AMBR means authorized member. So in an LLC, MBR or member means an owner. An owner can also wear the hat of an authorized representative. Let's say I start my business, I'm the sole owner, and I'm also the sole manager. Okay, I'm an authorized member. So in that case, it just so happens that Sunbiz will show me as the owner and also me wearing the double hat as an authorized member. So I can also bind my company. In that case, it happens to be an overlap between management and ownership. But if I have a silent partner in the business, for example, Sunbiz doesn't show the ownership. So keep that in mind. How do you search for information? So when you click on the search tab on Sunbiz, this screen opens up. I actually broke it up into 2 columns because it didn't fit on the slide, but it's broken down by sections, right? So you need to know what it is that you're looking for in order to look for it in the right section. Are you looking for a corp, for an LLC, a limited partnership, or a trademark? Click in one of these sections and search based on the corresponding criteria. Are you looking for a fictitious name or a DBA? You're gonna look over here, right? And so on and so forth. The point of this is that it's a simple system to use. There's a lot of information that is publicly available, which is a good thing if you're looking for stuff, and it's a bad thing if you want privacy, right? So if you want privacy and you're an owner of a company, maybe consider hiring a manager so you don't have to list your name as the sole authorized member and disclose the ownership structure. Hire a third party, designate them as a manager, and list their name instead. And that's how you protected, sharing ownership information with the world. Sunbiz is an amazing tool. I encourage everybody to spend 15 minutes to go on the website and just play with it a little and get familiar with it. Taxes, really important stuff. How do you tax your entity? Is it going to be a separate legal entity subject to double taxation because the entity pays its tax and then the owners pay their own taxes on dividends? Or is it going to be a pass-through, right? Like a disregarded entity for tax purposes, or like a partnership or an S-Corp that provides its owners with a Schedule K-1 that gets added to your individual income? That depends. Is it going to have foreign owners? Is it going to pay salaries to the owners? Is it going to use a lot of debt or own real estate or hold investments? Is it going to export products? There's a lot of tax credits and incentives for corporations that export goods and services. Is it going to deal in controlled goods such as alcohol and tobacco, which are subject to excise taxes? There's a lot of questions and there's a lot of rules and they're very difficult. So the conclusion, the conclusion is speak to a professional. Don't put yourself in the situation that I described earlier, which is that you run your business willy-nilly for an entire fiscal year and then come April 14 of the following year, you're like, oh my God, what have I done to myself? I now have to pay $20,000 more in taxes because I didn't plan this properly. Invest $1,000, $2,000 ahead of time to speak to a competent CPA who's going to do your tax return for that amount of money and to plan ahead. Bank accounts, we said, you have to kiss, keep it separate, seriously. Avoid commingling assets, avoid using business funds for personal expenses, personal funds for business expenses. That is a terrible thing to do. Keep separate accounts. One is for business, one is personal. Keep separate accounting, right? Separate books. This is my reconciliation. This is my company's income statement and balance sheet. If you need to create an overlap because, I don't know, maybe you need to buy something and you don't have the company card with you at that moment, or you need to buy it in cash because they don't accept the card, then it's okay to use your personal funds for it, but document it, right? You need to get reimbursed for that company-related expense. So make sure you get a receipt, take a copy of it, write a note on it. I bought ink for the office printer. This is an office expense for my business. Give a copy of that to the CPA that you hired because you listened to me. They will know what to do with it. This will prevent you from running into this huge issue, which is called piercing the corporate veil. What does that mean? If you start commingling assets and somebody decides to sue you because, you know, stuff happens, right? And people get sued all the time, then what the person who's suing you gets to say is, Judge, this business owner is not treating the business as a business. He's treating the business as just an extension of himself, because whatever belongs to the business belongs to him, and whatever belongs to him belongs to the business, and there's no Chinese wall in the middle. So you should disregard the separate legal existence of the company. You should let me get a judgment against the individual owner himself or herself, right? That's what piercing the corporate veil means. In other words, all of these efforts that we've done to plan and separate and create the company and pick the best entity, it's all gone because you commingle. Don't do it. Permits and licenses. So we talked about this beautiful tool website that I encourage everyone to visit. It's really amazing, very well done, very simple online wizard that asks you a couple questions and then spits out all the relevant information. Check with your, you know, at the federal, state, county, municipality level, there's a lot of permits, licenses, certificates that are applicable to every different business. It changes based on the business, based on the zoning requirements of the particular area. It gets very convoluted and very detailed, granular, right? So it takes time to make sure that you're doing this right. Again, get a professional if you can. The Open My Florida business website is a great starting point, but it's not the end all be all. This that you see here is just an example of, in this case, it's a county requirement, which is that every business has to apply for and obtain and renew on an annual basis a local business tax receipt. It's sort of across the board requirement. Everybody needs it. Corporate formalities. In initial governing documents. So this is the stuff that I said that I love, but that not every business owner loves to read as much as I do. So this is the rules of the game, right? In other words, you form the company, you create its internal governing documents, which are the operating agreement for an LLC or the shareholders agreement and the bylaws for a corporation. And these documents regulate the relationship between the ownership, the management, and the company. And they say, this is how we vote. This is how we make decisions. This is how we transfer ownership. This is how we give equity bonuses. This is how we run our business, right? It's the rules of engagement. And then on an ongoing basis, on an annual basis, you have to keep records for your business, right? You have to keep minutes of your meetings. You need to have resolutions for company action. How do we know that the company did something? It's not like a person where you say, well, yeah, I remember what I had for lunch yesterday. A company doesn't remember anything unless it's a record of the company. Company doesn't have a brain, doesn't have a memory. It only has internal records. Annual reports. Every year you need to file an annual report on Sunbiz showing your management. Ongoing compliance. If you don't do it, the state of Florida dissolves your entity, charges you fines. Okay, so it's important to keep track of these ongoing compliance requirements. Or else, same thing as commingling assets. If you fail to treat your company properly, if you fail to implement these ongoing compliance procedures, somebody, a creditor who's suing you, is going to argue that you're not treating your company as a company. And if you, as its owner, are not treating the company with the respect it deserves, then why should the judge? Okay, so very important, make sure you can take advantage of that limitation of liability when you need it the most. And the way to do that is to plan properly, be compliant, and do all the boring stuff, because that saves you when it counts. Conflict among owners. So we're now shifting into the more philosophical realm. But I find this area particularly interesting because as an attorney, I often see what happens when things go wrong. And so I used to be a business person and a business owner before becoming a lawyer. So I was on the other side of the table. And I know, and I remember, and I felt, and I lived through the process of starting a business and the excitement and the planning and the focusing on the making money and you know, financing and all of the operating or operation related stuff that goes into it. When you're in that process, it's very hard to step back and say, oh, let me think about philosophy, right? But it's so critical to do it, and it's so critical to do it right off the bat, because that's how you avoid issues from arising later on, or at the very least minimize them, right? There's no complete vaccination. But so what happens at a philosophical level? Well, first of all relationships start well, right? When you go into business with someone, it's because you like them. They're your friend, they're your spouse, they're your, you know, whatever, family maybe. And so, yes, we love each other, so much so that we don't just want to see each other every day. We also want to do business and have our money invested together, right? But money changes everything, unfortunately. People get greedy. People want to get paid more. People don't want to pay more. People can't agree on how to share the money. It happens all the time, especially when there's a lot of money at stake or when there's not enough money. So it's important to prepare for the hurricane. And when do you prep for the hurricane? It's before the hurricane. It's when everybody's getting along that you need to bring up the tough topics, the difficult conversations, the areas of disagreement. You need to explore those uncomfortable issues and situations and problems that could arise early on when everybody is on the same page or is getting on the same page. In other words, it's much better to say, listen, let's have the tough conversation. And if for whatever reason you don't like my answers, we don't have to do business together. Let's go our separate ways. Maybe it's not meant to be. It's better to cut it off early as opposed to after you put your money in, because now it sucks and it's annoying and it's stressful and it's aggravating and it's expensive. So communication is key. And it's important to communicate early, communicate clearly, if possible, memorializing the communication. And this is lawyer talk, right? Follow up in writing, make sure that whatever it is that was important, that was communicated, is memorialized in writing. And if possible, that it's included in those initial corporate documents, in those organizational documents that we talked about, so that it's translated legally into becoming the rules of the game, so that everybody's on the same page, right? So what should you talk about with your partners? Well, ownership is a big one, right? Who's gonna own the business? How do you get ownership? What do you give in order to become an owner? So contributions, cash, property, services, sweat equity. Is it going to be a combination of a little bit of all of them? Which is it? this is one of those follow-up in writing conversations. In other words, you never want to be in a situation where you're supposed to be the equity partner and your buddy is supposed to be the capital partner, the cash partner, but because there's nothing in writing, 3 months down the line, when you need that additional cash, your partner says, I don't remember agreeing to that. And you don't have any evidence. Oh, but we talked about it. Yes, but it's not an agreement. It's not binding. It's not written. When did that happen? How can you prove that in court? Right? So important topic. Voting versus economic rights. This is an interesting issue that comes up often. And I don't want to say it's a misconception, but there is an assumption. There is an assumption that if you want to get like a profit-based return on the investment, you have to be a full-blown owner. And you don't. That's not true. So you can split those and be very particular about what the person gets and what they don't get. So for example, let's say that you own your business, it's 100% yours, but you work with this manager who's like your right hand, and he or she is phenomenal, amazing worker, and you feel that you want to align their interests with yours and with the interest of the company. You say, I want to give you an interest in the profits of the company. But you don't have to couple that with ownership. You can just say, hey, here's a bonus at the end of the year that's calculated on a formula based on a percentage of the net income of the business. And that's that. That's an alignment of interest on the economic portion, but that doesn't confer that manager voting rights, for example, right? Let's say one day you decide to retire, your manager doesn't get to say, no, you can't. Your business partner can. Your business partner could say, well, now we have to dissolve because I don't agree with you leaving, right? So think about how you want to structure that as you get into the business. And of course, this is not necessarily applicable to everyone. It doesn't always get so complicated, but there are often circumstances where this is an issue. And I have seen, so the flip side of that is when you do give the equity to that manager, when you do give them actual ownership, now what happens? Does their performance change because now they get to sit back and relax a little bit? So think about all those aspects as well. Right to information is a similar analysis. In other words, with ownership comes a right to be aware of your business, right? So you get to request copies of the financial statements, tax returns, ownership lists, minutes of meetings of the company, all the internal books and records of the business. Now think about that for a second. Let's say that you're the sweat equity person who's doing all of the heavy lifting of the day-to-day work, and then you have a silent partner in China, right, who has no clue. This is just a bajillionaire who has no clue about how to run the business. You don't want them snooping around every day asking you for stuff. You're trying to do your job, right? You don't have time for that. You don't have time to teach them to do your job. So it may make sense. There may be circumstances where it makes good business sense to say, listen, you're an equity owner, yes, but you're a silent partner. So I'm going to give you the financial statements. You're going to know if I'm doing well or not. If the company's doing well or not, you're going to get a copy of the tax return. Leave me be. Let me do my job. I don't have time to deal with you. Okay. There's situations where, as harsh as it sounds, that makes a lot of financial sense. Management and decision making. So who calls the shots and what types of shots, right? Is it a decision to pay the FPL bill? Is it a decision to start a new line of business? Is it a daily, ordinary course of business type decision? Or is it a major transaction, an extraordinary decision? Do we want to merge with another company? Do we want to change the name of the company? There could be tiers of decision-making authority, right? So there could be certain people who independently can say, okay, this is a good FPL bill and it's now due, and so I'm gonna pay it and issue a check in the name of the company. But maybe that same person who would be, I don't know, your bookkeeper, for example, maybe that person doesn't get to decide if you merge with Coca-Cola next year, right? Maybe that's an ownership level decision, maybe even a super majority ownership decision. It's so important, it's so vital. What if you want to dissolve the company? You want to decide when to end it, right? So there's different tiers of decision-making authority, and all of that gets put into the initial corporate documents, the operating agreement, the shareholders agreement, and all that stuff. Tied with management is this concept of fiduciary duties. This is really important. It's something that not a lot of people know. So there's this really important thing. The analogy I always use is that becoming a manager of a company, it's a little bit like getting married. In other words, creating that relationship now all of a sudden imposes on you a number of legal obligations. For example, you get married, you have children, and if you get divorced, you have to pay child support. It's something that you don't sign an agreement to eventually pay child support. It's just an obligation that is born out of this new legal relationship that you created of the marriage and the parenthood, right? So fiduciary duties is something like that. You don't have to agree to it. It's something that is imposed on you by law when you are in a management position. So let's say you're the manager of a company, or you're a director, you're an officer, you're the CEO. If you're the only owner, it doesn't matter because you owe duties to yourself, or you're going to sue yourself. That never happens. But if there's other people's money that you're playing with, right? So if you have investors and you're the manager, you're the decision maker, you have a responsibility to them, right? You have duties to them. You need to act as a fiduciary. So there's three types of duties that apply to a fiduciary in Florida, which are the duty of good faith, the duty of due care, and the duty of loyalty. Good faith is pretty simple. You can't act in bad faith. You can't intentionally try to screw the investors. That's a no-no. Can't do that. Duty of care. You have to be reasonably competent in what you're doing. You cannot be reckless in making decisions about other people's money, right? This is not your property. If you borrow your car from your friend, you need to respect the speed limit. You need to stop at the stop sign. You need to watch for pedestrians. You need to be careful. You need to exercise due care, right? You can't drink and drive. You can't be reckless about it. Same thing, when you're running a business that's funded with some other people's money, you can't drink and drive. You can't be reckless with their money. If you're not a CPA, you can't prepare the tax return for the entity because you don't know what you're doing. You're being reckless. You need to hire somebody who is competent and can fill in the gap in your knowledge. If you don't know yourself, you need to rely on competent professionals who give you advice. And that's how you comply with your duty of exercising due care. You need to be careful. Duty of loyalty. You need to be loyal to the company and to its owners. You can't all of a sudden find a great business opportunity and say, oh, this is a really good investment. I think I'm going to profit for myself. No, you need to act in the best interests of your business partners, of your shareholders, of the owners of the LLC. Okay, so these are the three key fiduciary duties in Florida. Deadlock breaking mechanism. Let's say, very typical scenario, that you and your best buddy start the business and you're 50-50. And let's say that all of a sudden there's a decision where one of you says yes and the other says no. What happens? That's a deadlock. That's a decision where the company can't move forward, can't move backward because there's no consensus. There's no majority. There's no understanding. There's no meeting of the minds. And so what does the company do? The company dies. That's the default under the law. In that case, either one of you can go to court and can say, Judge, please kill the company because it can't move. It's paralyzed. it's dying. We're bleeding, we're paying money, we're paying expenses, we're paying rent every month, and we can't decide on this big issue. We're deadlocked. So create and discuss with your partners what happens when there's a disagreement of that sort, a deadlock breaking mechanism. Maybe we go to a third-party referee, maybe we flip a coin, maybe we, whatever, one time I decide, next time you decide. Whatever it is, there's many different ways to do it. But the point is that that's one of the things that you need to discuss, because at the end of the day, as the saying goes, there can't be too many chefs in the kitchen, cooks in the kitchen. Transfer restrictions. Now we get into the more technical part. Who do you do business with, right? So let's say you start business with person A, and then person A 10 years later says, oh, you know what, I'm gonna sell to person C. Well, maybe you don't know person C, maybe you do know them and you hate them and you don't want to do business with them, right? So discuss whether you want to implement rules that restrict the ability to transfer ownership. Now, mind you, generally these are reciprocal. So it's a double-edged sword. If you prohibit them from doing something, then they're going to say, well, you too, right? So it's important to think about those and structure them properly. Finally, the 8 Ds of doom: death, disagreement, disability, disinterest, divorce, dissolution, diversion, distrust. Now, in a way or another, we've somewhat addressed these, but it's sort of like an easy way to think about the 8 Ds of doom. The point is, these are difficult conversation topics that people may not necessarily want to have with their best friend, with their spouse, with their, you know, soon-to-be business partner, but they are so fundamental because this is where the problems, this is what creates the problems later on. And so address it early, tackle it early on. All right, so one final comment, I guess, couple final comments, but one is get help. All of this is complicated. It's a lot of information. So get help. I find that the 3 musketeers, which is really 4, I always found that interesting, but the 3 musketeers of every business should be a CPA, a banker, a lawyer, and an insurance broker, right? So these are the 4 people that you want to have next to you, together with your business partners, right? But as you create the infrastructure for your business. Key takeaways from today is step 1, learn and be competent as if your future and that of your company dependent on it, because it does. You're about to invest a lot of time and money into this venture. Make sure you know what you're doing. Plan ahead, which is the step immediately after that. Create a team, possibly with the 3 musketeers, which is really 4. And then don't be afraid of difficult conversations. Tackle the issues early on. Talk to your partners. Make sure you're actually on the same page. And this is it. Or is it just the beginning? Hopefully, you've taken away a lot of useful information today. So now I guess we have some time to tackle some questions. And also, this is a QR code with my firm's information. If anybody thinks of another question later on after the presentation and wants to shoot a quick email.
Yes, I have some questions for you. Okay, let me see. Okay, I really need some help applying for a loan for bus transformation. Oh no. Okay, so for Emma, in regards of the loan for the bus transformation, or is that Emmanuel? Yeah, Emmanuel. Yeah, so what we've been talking, get email about your loan transformation for the bus. So you're taking care of it on that side. Okay, now for you, David. So a startup entity with the goal of providing residential life skills intervention to cultivate young adults. Nope, that's another comment. Okay, here it is. Can I use a company card to buy a gift for family member? Is this considered commingling?
Yes.
Okay.
That was an easy question. So look, unless that family member is also somehow a supplier of your business or a service provider, yeah, that's a red flag.
Okay. If I have an existing LLC am I able to change the name of that LLC, or do I need to close it and open a new name?
You can change the name. You can apply for DBA. Both of them are very easily done, and both of them are done through Sunbiz. So that's the website that we looked at earlier. Go on it. It's relatively simple forms. We can also help with that, of course.
Okay. Okay. I wanted to hear about NDA and non-consent, but nothing was said today. Perhaps a topic of the future, or do you want to elaborate a little bit more on the NDAs and non-consents?
Yeah, I'm happy to talk about NDA. So an NDA, non-disclosure agreement, sometimes called a confidentiality agreement, sometimes called restrictive covenant. It's essentially a zip it obligation, right? So, and the agreement is a lot, fancy terms, fancy legalese, but basically what it says is my company and another party A and party B, are going to exchange some information which they want to preserve as confidential. And so vis-a-vis third parties, each of us has to zip it. And internally, we need to implement certain measures such that the information doesn't accidentally leak. So we're not going to print 1 million copies of a confidential document and leave it on the porch. We're going to implement security measures and restrict access and only share with people who actually need to know that information, right? If the company has 1,000 employees, we're not going to give confidential documents to all of them. We're going to give maybe only to the CEO and the CFO or whatever. In addition to that, there can be additional restrictions that come with the confidentiality obligation. So you would have a non-compete obligation that's tied to it. So we're going to exchange confidential information, and because we're in the same industry and we're contemplating a proposed transaction together, we also agree that we can't use that confidential information to compete against each other, because that would be unfair. That would be against the spirit of transparency and disclosure, which is the whole point of why we're doing this. You could have non-solicitation obligations, for example, that say, listen, as part of the information, I'm going to share a list of customers. If you are planning to sell the same products as me, you can't use that against me because you're going to go after them and steal my customer base. So NDAs, confidentiality agreements, they're documents that revolve around this concept of sharing information within a safe environment. And what does that look like? It depends on the transaction. It depends on the circumstances of the sharing. It could be bilateral. It could be unilateral. But generally speaking, the concept is, let's create a safe environment so that whatever the reason for the sharing is, we can do it knowing that that information is not going to be used against us. And that's how we ensure that there's a fair, accurate, complete disclosure of whatever it is that we need to know. That's basically the summary of what an NDA is, what it does. There's additional legal details to it, like remedies, injunctive relief, and all those things. But that it's hard to have a general conversation about the specifics, because that changes depending on the specific language of the document. This was a very high level overview.
Okay. What if my company is funded by an international partner?
What if it is?
Yes.
I mean, I'm not sure what that question, so there's many aspects to that, right? If the question is, can I do it? The answer is yes, of course you can do it. It could be in the form of a loan. It could be in the form of equity, capital contribution. Foreigners can have ownership in US companies. Now, if the foreigner wants to be an active participant in the business and work in the United States, now there's an intersection of different laws, for example. So the question becomes, can a foreigner from a specific country work in the United States if they're also an owner of that business? Maybe they can. Maybe they need to apply for a social. So we need to look at those restrictions. Maybe they need to get a visa, get a work permit. So can it be done? Yes. The answer is generally yes. How do you do it, and what specific items you need to check off on your list? it depends on the parameters of what does that relationship entail. Does it entail also employment? Is it just a loan? Is it just capital? Is it management? Is it executive decision?
It was more for meant for taxes. He doesn't work here. So it
So,
could be a international employee.
so for taxes, again, it depends on how the money goes out of the company and what type of company it is. If it's taxed as a corporation, a C-Corp, which is the double taxation, or if it's taxed as a pass-through as a partnership. It's not going to be an S-Corp because an S-Corp cannot have foreign owners. So that's an easy one. Typically, this is not a rule. This is just what I see often in practice. If you have a foreign owner in a pass-through entity like a partnership or an LLC that's treated as a partnership by default, the foreign person is going to have to file a personal US tax return because that's just how the partnership rules work. Oftentimes, if I'm a bajillionaire from Hong Kong, I may not want to disclose all of my earnings to the IRS. I don't want them to know that. So it may be preferable in that situation to create a C-Corp where I personally I as the foreign owner, don't have to personally declare my income in the United States. My company does that. So the disclosure is more limited in that sense. There's a little bit more privacy, but it comes at a price because now the company pays taxes, and then when I get the money, I also have to pay taxes depending on whatever the international treaty is. International taxation of investments and cross-boundary flows of money is immensely complex because you have local laws, you have international treaties. So if the Internal Revenue Code wasn't complicated enough, there's an additional layer of complication, which is the international agreements. You have multilateral agreements, you have bilateral agreements with specific countries. So there's really a lot of tax issues that need to be addressed by a CPA, and not just any CPA, a CPA that has experience dealing with international tax issues with that specific country, because it gets that detailed. So there's a lot to that topic.
Okay, how does a non-compete work internally to the company, i.e. employees taking on new business as individuals, vice under the brand of the business?
So it depends on how you write it. It could be very broad, very specific. You can, so I sometimes get the question of, is a non-compete enforceable? And the answer is yes. In Florida, it is enforceable. There are some guidelines and some laws about it, because generally speaking, they are disfavored, right? For policy reasons, our economy favors open competition. So any restraint on competition is frowned upon, but that doesn't mean that it's invalid. So as long as you comply with certain statutory requirements and certain rules, you have flexibility in determining what limitations apply to your employees, to your, business partners, to whatever is the subject of the non-compete. And you can do it by product, you can do it by type of information, you can do it by activity, you could do it by geographic area, which is a mandatory restriction. The time frame, which is another mandatory restriction. So the law in Florida is that a non-compete cannot be overbroad in terms of these two parameters, cannot be overbroad geographically, and cannot be overbroad, overlong in terms of time, cannot be like a forever non-compete. And then in terms of remedies, so what happens if, that also depends on how you write the agreement, but generally speaking, you could seek what's called a remedy at law, so monetary damages for breach of the non-compete, which means you sue the person and you recover your damages. If somebody it's not supposed to compete with you, and they do, and they make $100,000 by competing with you, you sue them for $100,000. You can't make more than what it is that they got, right? In commercial cases, what you recover is your out-of-pocket loss, basically. You don't get to punish people for breaking their promise. And then the other remedy, which is very useful in these cases, in cases of other covenants like confidentiality and non-solicitation, those are the big ones, is what's called injunctive relief. This is like a restraining order where basically a judge, instead of saying pay X dollars, they say cut it out, right? So you get both. So you go to court suing to enforce a non-compete, and a judge can issue an order saying you stole the business and caused $100,000 worth of damages, so pay that back, and also stop stealing the business, cut it out. And then if you keep doing it, you're in contempt of court, and there's even criminal sanctions for that. So this is the very sort of broad overview of what it is and what you can do if it's breached. The language of it, that's where you need a lawyer, because depending on what you want to protect and how and for how long and what the law is, you need to sort of, connect all of those dots to write a good enforceable agreement. A quick note on non-competes, there's an upcoming Federal Trade Commission rule that's still proposed, so it's not been finalized. But there's a lot of talk about this rule that will presumptively void all non-competes that are entered after a certain effective date of the rule. This is not currently the law, so the rule is not valid yet, but it is a proposed rule, and we'll see if it gets approved, if it gets modified, how it gets interpreted by the specific states in each jurisdiction. So there's a lot of movement in the process still. The dust hasn't settled yet, but I just thought it was relevant to sort of as a quick news announcement.
Okay, I got the last 3 questions here. Do I need to file a tax return on an EIN even if I have not done business under that EIN?
Yes. So the moment that you have an EIN, that company exists for the IRS, and you need to file a tax return. Now, that doesn't mean you have to pay taxes, right? You could file a 0 return, or maybe you're losing money for that year, for that matter, and so you may not need to pay anything in connection with that filing. But yes, you need to file. There's penalties for failure to file, even if you don't owe anything. Even if it's a 0 return, the IRS penalizes you for not filing timely. So, it's not a huge penalty, of course, if you don't owe money, but it's like, I think $500 a year or something like that. So do the filing. Or if you're not using the company, in other words, if you just have that EIN because you started a business and then it didn't work out and now you're stuck with it, what you're supposed to do is what's called a final return. So basically, in the final year of operations of the business or portion of the year, you need to file a special return where your accountant selects certain options that basically tell the IRS that the business is no longer going to be active. And so at that point, the IRS knows, okay, we're not going to expect any more filings from this EIN, and that's the end of that.
Do you recommend prepaid legal services for simple tasks such as reviewing contracts?
So I don't have personal experience using them. I have heard 3 people now. I didn't even know really that was a thing, so shame on me. But in the last maybe 3 months, I have heard at least 3 separate people telling me about it and complaining to me about it, because they always say I can never speak to the lawyer and they do such a botched job and I can never get my questions answered, and I'm always on a hold on a phone service. So I don't know. My point is that at the end of the day, you get what you pay for, right? So the value of a lawyer, I think, and then maybe some lawyers will disagree with me, but the value of a lawyer, I think, is not so much in giving you a cookie cutter form, because you can get them. I mean, Chat GPT writes contracts now, right? So it's not that. What makes it different is the fact that you get to speak to someone who hopefully understands what you're trying to do and translates your desires from English into contract language. And that's the value add, right? So understanding what you want to do, giving you advice on what's the best way to get there, keeping in mind the consequences of your decision, understanding the risks, evaluating that, minimizing it, figuring out strategies together. It's not just getting the form. I've seen some clients that have downloaded forms off the internet, and just to give a quick anecdote on that, it was a fairly sophisticated client, actually, a pretty big company, and they downloaded this sort of, I don't know, master service agreement for their services off the internet, and I read through it and I was like, wow, this is really a good document. And then I go all the way to the applicable law, and it was the law of Canada. This is a Florida company that all of a sudden agreed to litigate all of its customer cases in, I don't know, Ontario, under the laws of Canada. And I looked at the client and I was like, that's the danger of Google. I mean, what have you done to yourself? So anyways, that's the danger of that, I feel.
Okay, and the last question. What if you need a loan to fund yourself, like a loan yourself funds to support the startup while growing, improving, establishing business credit? What do you suggest? As such, the creating bonuses versus percentage of business to a great potential manager I want to bring and have more invested towards the business. What is that termed as?
So I think that's, it sounds to me like it's two questions. So the first one is on the personal loan side for funding the business, and the second one is on the percentage
Correct.
sort of economic incentive. So I'll tackle each in turn. So the first question is, it's okay to do it. So can you do it? The answer is yes. Would I recommend doing it? The answer is no. The reason for that is because the moment you take a personal loan, you are personally responsible for that amount. So whether your business is successful or not, you still have to pay it back. So that whole concept of separate legal entity, limited liability, it's out the door. Now it's your loan, your problem. Now, in practice, most small business loans are in fact the equivalent of a personal loan. Why? Because the bank asks for personal guarantees. A personal guarantee is a document that every lender requires from small businesses, saying, listen, your business is new. I don't trust you because you're not Coca-Cola. And so if you're really in it to win it, you need to put your money where your mouth is. And so if your business can't pay me back, you're gonna. So that's a personal guarantee, is when the owners become personally responsible and guarantee the obligations of the business. This is typical in loan documents, leases, right? So sort of big capital obligations. And so as a practical matter, would I say absolutely not take a personal loan to fund your business? I mean, listen, it's a risk decision at the end, right? We're all adults, and there's no crying in baseball. It's a personal obligation, so you're on the hook for it. If you were to take a small business loan, you would probably also be on the hook for it. What I definitely advise against is don't. So this is like the Miami mentality. I'm not trying to be I don't know, annoying when I say this, but I've heard stories of people that go to their accountants, not CPAs, but their accountants, and they file tax returns overstating their income, so that then later on they can ask for a loan based on fake numbers, so that then they can fund a business or buy a house and all of that. And guess what? at the end of the day, they can't afford it because the income wasn't real. So don't do that. That's a silly way of taking on risk. If you take on a calculated risk and it makes sense, and maybe you get a better rate on a personal loan versus a business loan for whatever reason, if there's a rational economic value to taking on that risk, then yes, maybe do it. But otherwise, to the extent that you can limit your liability, limit your risk, minimize it, reduce it, give only a limited guarantee for the loan, then do that. With respect to the other question, which is the economic incentive, it's really up to you and the metrics of your business. In other words, is this person great? Do they deserve 5%, 10%, 15%? Should it be based on revenues because they have more of a salesperson kind of relationship in their business? Should it be based on net profit because they also get to manage the expenses, and so you want to incentivize efficiency with respect to minimizing costs also, as opposed to just maximizing sales? It depends, right? You can structure it in any way that you want. The beauty and what I like about what I do is that you get to be very creative when writing a contract. It sounds like a dull and boring thing, but there's actually a lot of thinking and sort of creativity that goes into it, because depending on what your clients, you, the business owner, depending on what you want to do, what you want to accomplish, you can shape the document, the bonus agreement, whatever, in the way that you want to shape it, and you can make it work for that specific situation. And it could be very broad, or it could be very particular just for that person, for that industry, for that specific question, for revenues generated in connection with a specific client account that you brought in from your prior experience. In other words, you get to be as granular and as specific and as creative as you want to be, depending on what works best for you.
All right, I want to thank you for everyone for attending today's webinar. But like I said, if there's any particular questions, concerns, don't hesitate. In the chat, there's my email address, and I will be more than happy to connect you with the appropriate channels. But Davide, thank you so much, for the presentation. And but like I said, anything that we can do to help you out, just let us know, and we'll be more than happy to do so. So thank you, everyone, and have a good afternoon. Take care.
Thank you. Bye-bye.